start with very basics. What is an AIF? I think this question is sometimes important because we hear from some clients that we want to set up a partnership vehicle to pool money from family and friends. Is it okay? Can we do that? Do we need to go to SEBI for approval? Do we need to go through the rigors of an AIF, or can we just go ahead? There's no straightforward answer to that. If you set up a LLP as a pooling vehicle, then the registrar of partnerships does not allow, or rather the ROC does not allow you LLP for financial services. So you have a roadblock over there. There are examples where people have set up unlimited liability partnerships for pooling money from family and friends. So far, there has not been a lot of questioning on this structure, but if you ask me, it is not the cleanest way for pooling money outside a family and then investing in stocks and other securities. So therefore, what the SEBI AIF regulations define AIF as a privately pooled investment vehicle which collects money from investors, whether Indian and foreign, for investing in accordance with a predefined policy. So as you can see, the definition is very wide, and any pooling vehicle is set up where money is pooled together comes under the AIF regulations. There are a few exceptions. So if you have a family trust or a ESOP trust, employee welfare trust, if a private company sets up a holding company for investments, and let's say a Tata Sons pools money from different companies and then invest downstream, that is not an AIF. Or if there's a securitization trust, or if there's a trust or a fund which is regulated under any other law, for example, REITs or InvITs. So that is for starters. And then, this is our typical AIF structure we'll look at. If you see both, if you have domestic and foreign investors, you have a few options. And more and more we are seeing Indian fund managers are pooling money or getting money from NRIs and other foreign investors. There are a lot of considerations to be looked at, because if you go through the FPI route, you set up a fund abroad. And typically people are now doing it in Dubai or Ireland as compared to some other jurisdictions like Luxembourg, which is very costly. In some cases, people have used the VCC structure in Singapore. But if you do all of that, then you have the 50% NRI restriction, which means all NRIs put together cannot be more than 50%. Single NRI cannot be more than 25%. So that is one reason why AIF structure can be very useful, because your NRIs can come directly in the AIF, or you could set up a company or a pooling vehicle abroad, which will not be an FPI, and that will pool money and put it into the AIF. Your foreign pooling vehicle need not be an FPI, because AIF investments from foreign companies comes under a different route. It is neither FDI nor FPI. So that is one structure which is possible. Or if you don't have the 50% NRI problem, then you have two ways, or rather three ways to do it. You can directly invest from abroad in Indian securities by getting an FPI license. So that's like a co-invest structure. You can have an FPI license but invest into the AIF. That's a unified structure. Or you can now use the gift city route. And even within the gift city now, there are multiple ways to do it. People are doing it in different ways. Either you set up a fund abroad. Let's say you set up a company or a fund in Mauritius, pool money into the gift AIF, and then from there you invest domestic. Again, the same problem is there, because a gift AIF has to get a FPI license to invest in Indian securities. So again, AIF comes to the rescue here, a domestic AIF. You pool money into the gift AIF, and then from there you invest in a domestic AIF. Now that is not considered as FPI. So that has certain advantages. So what you're basically doing is your offshore pooling vehicle, you're replacing that with a gift pooling vehicle and getting various advantages which a gift structure provides. Now, this is all useful if you have a decent amount of NRI or foreign investors. If your investors are not material to start with, then you directly bring them into the AIF. That becomes most easiest. Now, within a unified and a co-invest structure, again, we have seen people using either or. Both have their own advantages. For example, if you have a unified structure, which means everything comes in the AIF, then you get a higher AUM. It helps you to market, because now everything comes in the AIF umbrella. You can offset losses and profits of the NRI side and the domestic side. So that's one advantage. And then you don't need any approval, as I said, because that is not a FPI investment. But then sometimes we have seen clients want to segregate NRI investment from domestic investments. So they follow the co-invest structure where the foreign money comes as an FPI and domestic money comes as a AIF. So other than that, in this structure, you have a trustee. I think we have trustees here which will take you through their role, etc. You have a domestic custodian, and you heard that from Udit earlier. You will need to have a manager which has to be based in India, cannot be based abroad. And then you can have a sponsor. You have to have a sponsor which can either be in India or it can be abroad. Now the sponsor and manager can be the same. The regulations don't require you to have a different entity. But then for various reasons, it is advisable to have the manager and the sponsor as two different entities. For example, one reason could be that if your sponsor commitment comes from a different entity, which is a sponsor, then you can pay the return to that sponsor in the form of a return on the investment as performance fee rather than paying it to the manager, in which case it becomes management fees and is taxed at a higher rate. There will be GST implications and all of that. So there are certain advantages of getting sponsor contribution from a different entity. But one thing to keep in mind there is that if your sponsor and manager have the same shareholding, then tax authorities can look through and say that you have just created two entities for namesake, but both have the same shareholding. So whatever you are paying to the sponsor, we will also treat that as management fee. So you have to take care of that while doing your structuring. And then the AIF itself can be either a trust or a partnership or a company. In most of the cases, I would say 8 to 9 out of 10 cases, we have seen that the AIF is set up as a trust. It is much more easier in a trust structure to bring investors, to redeem investors. There is a confidentiality angle to it. Whereas if you have a LLP or a company, then anybody can go to the ROC website and then get details of the investors and balance sheet and stuff like that. And then the LLP and company structure are really not meant for a fund. So whenever you want to do a redemption, you have to amend the partnership deed or you have to do a buyback, etc. for redeeming the investors. So it's not a very easy structure from a fund point of view. Then if you're managing foreign money, AIF becomes again tax efficient because you are a manager sitting in India managing an Indian fund. There is no risk of POEM, that is place of effective management, or PE. Whereas if you're a PMS and you're managing foreign money, then the foreign person can risk being considered to have a PE or a POEM in India and then tax at a higher rate. Again, sticking to tax, benefit under treaties is not available. That's one downside of AIF. So if you're a PMS investor and if you come from a country like Dubai or Singapore, etc., then you can claim the treaty benefits. But if you come in the AIF, then the taxation is levied at the AIF level. So you don't get the benefit of your tax treaty. Loss set-off, I think, is also important because if you're a PMS investor, then all that income flows to you. And if you have let's say, a loss on the PMS and gain somewhere else, then you can offset. But if you invest through the AIF, then that offsetting is not possible because generally what people do in the industry is pay tax at the AIF level. And as I said, give a statement to the investor, which is only used for disclosing income in his return. In terms of minimum and maximum investors, there's no limit. As we know in PMS, in AIF, it has to be a maximum of 1,000 investors. Limit is 1 crore versus 50 lakhs in PMS. And again, there's no tenure in a PMS. There's a fixed tenure, especially if it's a closed-ended fund in a AIF, 1, 2, or 3. Again, one more practical issue is that we have seen PMS investors sometimes copy the strategy because they can view their portfolio on a very regular basis. I have a PMS investment and whenever I want, I just ask my manager for a report and he just obliges. So it is very easy for the investor to replicate a strategy by giving 50 lakhs to the PMS manager and then making a 50 crore investment on his own. But in the AIF, that is much more difficult. Money is pooled together and it is difficult for the investor to replicate strategy. So I think that becomes another advantage from a manager point of view. Documentation is important, especially at the setup phase, and also from a manager or a trustee protection phase. And the key documents are, one is the incorporation document. So whether it is the trust deed in the case of a trust, LLP agreement, or a company articles or memorandum. The second is the PPM. This is like a prospectus in the case of listed securities. So PPM or the private placement memorandum contains all the key terms relating to the investment, right from background of the manager to the investment strategy to the key arrangement with the investors and other stakeholders, etc. I think this is like a Bible as far as the AIF is concerned, and probably that is why SEBI has prescribed a standard template, because in the past there was no standard template and SEBI used to struggle with ensuring that whatever disclosures it wants are incorporated in the PPM. So now there's a standard template, and if you don't comply with that, it will only increase the timeline for getting approval from SEBI. Then there's a contribution agreement. This is like the shareholder agreement between the manager and the investor. It lays down the key terms between the investor and the fund. Again, an important document, in which very clearly lays down the different aspects from an investor point of view. And lastly is the investment management agreement, or the IM agreement, I think, which is straightforward. This is on any fixed fee or performance fee or in respect of any setup or ongoing expenses which the manager needs to incur. I think this incorporates all of that. I'm sure many of you are aware, but just to lay down the key conditions under the AIF regulations. So for example, you could have multiple schemes, and I'm sure most of you are aware of that, and once you get an AIF license, then you can launch a new scheme or as many schemes as you want by filing the PPM with SEBI 30 days before the launch of the scheme. Co-investment by the manager or sponsor is not possible. Is permissible but not possible in terms of terms which are more favorable to the manager. Tenure of the AIF, it has to be minimum 3 years, and it can be extended by 2 years with the approval of more than 2/3 of the investors. And of course, in category 3, you can have an open-ended fund, and I will discuss the key differences between open-ended and closed-ended. But tenure, of course, is then not applicable in an open-ended fund. Sponsor commitment for Cat 1 and 2 is lower of 2.5% of the corpus or 5 crore rupees. For a Cat 3, it is 5% or 10 crore, whichever is lower. So if your size is more than say 50 crores, then at least you need to bring in 10 crores, and after that you don't need to provide additional sponsor contribution. Of course, you're free to bring in more sponsor money, but 10 crores is the upper limit. Then there is a concentration limit. For a Cat 1 and 2, it is 25%. For a Cat 3, it is 10%, which means out of the total investable funds, you cannot make investment in one company beyond 10% of the total capital. Now, this is one area where there was a lot of confusion, because as the market value increases, then managers wanted flexibility to invest more. So SEBI has clarified that the 10% can be applied on a base of either investable funds or the NAV at your option. And once you pick one, then you have to stick to that. Of course, you can't have any leverage in category 1 and 2 except to meet temporary requirements. In Cat 3, you can have a leverage of 2:1. The way the 2:1 is calculated is a bit complex, especially for derivatives, and is a bit harsh also, if I can say, because in the numerator, it also includes your assets which are not leveraged. So therefore, actually your 2:1 may not be a 2:1 leverage. But on the other hand, if you set up a gift AIF, then there is no leverage requirement. I mean, there are some other benefits in a gift AIF. For example, concentration limit is not there, your leverage is not there, and there are certain other benefits. Udit mentioned about custodian, so that applies for a CAT 1 and 2 if you have more than 500 crores of corpus. Now, as I said, open-ended versus closed-ended. Again, here I've seen people follow different practices in the market. I think it depends largely on your commercial objective, because if it's a closed-ended fund, then you can take money only up to final closing, as you know. And after the final closing, you cannot take more money in the same scheme from your investors. Of course, you can launch a new scheme, but then a new scheme means new PAN, new tax return, additional tax return filing, and it's not very easy. So if you have a determined set of investors, and if you have a proper vision in terms of where you're going to invest, there'll not be a lot of fluctuation, then a closed-ended fund would work. One benefit is that you can stagger your investor commitment. So the entire 1 crore need not come on day one. You can tell your investor to pay based on the first closing, second closing, etc. over a period of 2-3 years, whatever. So that's one benefit of a closed-ended. In an open-ended, on the other hand, your entire money has to come in one go. Of course, SEBI has now allowed partly paid units also. So that is something which has been explored by some AIFs in terms of, can I issue partly paid units and not ask the entire 1 crore from the investors in one go? I think that is possible. But the benefit is that it's like a mutual fund. So investors can come and go anytime. It provides you a lot of flexibility in that sense. The key aspect from my point of view is on tax, because there is a little bit of a perception, or I think there's a slightly higher risk of the tax treatment of an AIF not being accepted by the tax authorities in an open-ended fund. And the reason is that there is a little bit of illogic precedence as far as tax is concerned. There have been some court cases and a CBDT circular which says that the identity and names of investors should be known at the time of the setup of the fund. Of course, there have been some favorable rulings on that also, which is what we use for an open-ended fund. But because of this some of these negative rulings, in an open-ended fund, your investors will not be the same on a day-to-day basis, because obviously they'll keep on changing. So we feel that there is some heightened risk with the open-ended fund, that they might say that this is a discriminate trust and it should be taxed at the higher rate as against the normal 10-15% for a capital gains, for example. So far, we have not seen any questioning by the tax authorities, either in the open-ended fund or a closed-ended fund. There have been a few inquiries during assessment stage, but so far, these have been clearly accepted. So I hope that continues going forward. Now, in terms of setup timelines, I think it would take about 3 months on an average if you're really, you act very swiftly. Within a period of 3 months, you can get your FPI set up. So it take about 2 to 3 weeks for your structuring in terms of as investor, structuring your sponsor commitment versus investment manager, your existing structure and whether that needs to be modified and all of that. And it takes about 1 to 2 months to get the SEBI license. Of course, being a quasi-government authority, there's no commitment and there can be delays depending on festival and other things. But that's the average time. And then after you get the license, it will take about 7 to 10 days for other formalities with my other colleagues over here. So opening demat account, appointing custodian, and signing of various agreements with the investors. And in terms of registration process, just to expand on what I mentioned earlier, so the first step will be to finalize the structure of the AIF. I think this is very important, both from a tax point of view, as well as from a regulatory point of view, and also from a commercial point of view. Once you finalize the structure, then we will help in preparing all the relevant documents, which I mentioned earlier, the contribution agreement, trust deed, PPM, etc. And after all of this is the agreements are drafted, you can send an application to the merchant banker. He will have a review of that. That is as per the new process. and then issue a due diligence certificate and submit the application to SEBI in Form A. In the application, we only need to provide the trust deed and the PPM. The contribution agreement and the investment management agreement are not required to be provided into the merchant banker. And then SEBI, as per law, is required to respond back within 21 days, which sometimes happens, but often doesn't happen as well. And once SEBI comes up with any queries it may have, you will need to make changes to the PPM and the trust deed as required by SEBI and then resubmit the documents. After the receipt of registration, all the final documents, SEBI will then grant the certificate. This is a kind of broad indication of the cost involved. So your application fee is about 1 lakh. Sorry, this is in millions. I should have changed it to lakhs. Application fee is about 1 lakh. And then for a Cat 3 AIF, for example, the SEBI registration fee is 15 lakhs. And then if you want to set up a new scheme, then the fee again is 1 lakh per scheme. The below fees after that are really indicative. So fees for, let's say, a tax consultant or other service providers in setting up the fund will be approximately 10 to 15 lakhs. It can vary here and there depending on the complexity and other things, but that's the broad range. And then on an ongoing basis, again, fees for different intermediaries and consultants, including your audit, can be about 15 to 20 lakhs. So let's look at some of the key aspects of category 1 and 2 first. So benefit of category 1 and 2, where of course you cannot make listed investment more than 50% of your corpus, is that there is a full pass-through except for business income. So all your capital gains, dividend, interest will be passed through to the investors, and the tax liability is paid by the investor rather than the fund. The fund has to only ensure that it withholds a 10% tax for domestic investors, and for foreign investors it will withhold tax at the treaty rate. So therefore, investors get the benefit of treaty rates, which is not available in a Cat 3 AIF. Now, because of that, again, as I said, similar to PMS, investors can use it to offset the losses and gains. They can manage their tax position much better as compared to a Cat 3, where they have no control on the taxes paid. From 1st April 2019, losses also can be passed on to investors. Before that, it was not allowed. So let's say if you have a capital loss in a AIF 1 or 2, that can be passed on to the investor, and the investor can use that to offset his other income. But business income and losses remain with the AIF and cannot be passed on. An AIF has to pay tax on that and use it to offset any business losses. There's a specific reporting requirement for a Cat 1 and 2, 64C for reporting to the investors, and 64D form is for reporting to the income tax authority. Whereas for a Cat 3, there is no specific reporting format prescribed, but the market practice still is that an annual statement is issued by the fund in a format somewhat similar to 64C, and we help in preparing that statement, and if required also signing that statement, where the statement gives a detail of all the income and losses of the fund and attributed to the investor, and how much tax is attributed to the investor, and that statement is then used by the investor in his tax return. The same statement is also given when a Cat 3 investor is redeemed. As I said, Cat 3 taxation is a bit more complex. There is no pass-through available. So we apply the usual trust tax principles. Normally we treat the trust as a determinate, irrevocable trust, which means that the taxation of the AIF is in the same manner and same extent as if the investor would have invested in the underlying security. So we ignore the trust, and then if the investor would have invested in the underlying security, he would have paid a 10% long-term capital gains tax, a 15% short-term capital gains tax, 20% tax on dividend, etc. That same rate is applied, and the trust is only a fiduciary capacity acting to discharge the taxes on behalf of investors. So therefore, ultimately, this is a tax on the investor, but discharged by the trust. So we have a few examples where the AIF does not pay taxes. It relies on the investor to pay its own taxes. But then most AIFs are not comfortable with that position, because what if the investor does not pay his taxes tomorrow? The income tax authority can come after the trust and say that you passed on certain income to the investor and he has not paid taxes, so therefore you must pay the tax. And what you would have done is paid the full income to the investor without any withholding, and the tax liability can then come either on the trustee or the manager. So therefore, in most cases, AIFs prefer they pay tax at the fund level itself under the PAN of the fund itself. Again, we have a very few cases here where the AIF pays taxes, it controls the tax, but it pays tax in the PAN of the investor. But as you can see, if there are 100 investors, then paying tax under the PAN of each investor is quite cumbersome. So the market practice generally is therefore to pay tax under the PAN of the AIF itself. But just to let you know that the regime in IFSC is different from the domestic regime. It is more closer to international standards, in the sense that in the IFSC, the fund management entity, or as they call as the FME, is regulated and licensed rather than the fund itself. So the good thing is that once you go to the IFSC and get a license for the fund management entity, then you can set up multiple funds, multiple schemes without having to go to IFSCA for approval every time. This is more closer to what is done in developed economies, where funds don't get specific registration. But for tax purposes, the IFSCA has decided to issue some kind of a letter every time you set up a fund or a scheme, because income tax authority would recognize the fund or the scheme and not the manager. There are different conditions for different types of fund manager entities, somewhat similar to your domestic AIF regulations, but in certain key aspects like your leverage, in concentration limits, etc., they are much more relaxed. There are different kinds of schemes in the IFSC regime. So if you have a venture capital scheme, the conditions have been laid down for that. If you have a restricted scheme for non-retail like a AIF, the conditions are laid down. If you have a retail scheme like a mutual fund, conditions have been laid down for that. One aspect which I want to point out in IFSC though is that if you have time up to 31st March 2023 to relocate an offshore fund into the IFSC, and the relevance of March 23 is that if you relocate an offshore fund in the IFSC before that date, then it is completely free from any regulatory or tax burden. So no capital gains for the fund or the investor on relocation. You get your benefit of losses which are there, let's say in your Mauritius fund, they can be carried forward. If you have any grandfathering benefit in the treaty, that can be carried forward. If you have any cost, acquisition cost, that can be carried forward. Then from a regulatory point of view, the transfer is considered as free of cost. So you transfer, normally SEBI doesn't allow free of cost transfer, as you know, but you can do a free of cost transfer from the, let's say, the Mauritius fund to the IFSC fund and then close down that foreign fund. So complete exemption from both regulatory and tax up to March 23. Key steps for relocation, you can go through this. You first need to get an office space in the gift city. Again, here office space is required only once. Earlier there was some confusion that both the manager and the fund need to have separate office spaces, but now you need to have only one office space. Then you will make an application to the SEZ authorities, because gift city is a special economic zone. So you first get approval from the SEZ authorities. Then you set up your different entities, the fund manager entity, etc., which can be either a new entity or a branch of your Mumbai entity. And once you do the setup, you apply to the IFSC authorities for a license. And then the usual steps follow. You file your PPM with the IFSC authorities, you get your FPI license and all of that. What is the difference between having an IFSC fund versus an offshore fund? One is that IFSC fund is exempt from all capital gains tax except equity. So whether tax on debt on derivatives, etc., there is full exemption. If you are a US fund or UK fund, etc., you don't get all of that benefit. IFSC does provide that exemption. On dividends, there's a concession rate of 10% as against 15 or 20 under treaties. And interest, there's a lower rate of 4%. Importantly, there is no anti-avoidance rule in the IFSC. So if you're a Mauritius fund or a Singapore fund, you need to comply with the anti-avoidance rules in the treaty. So you need to show a substance, you need to show a purpose why you set up the fund there. With the IFSC, once you get a blessing from the IFSC authority and you maintain that substance which has been prescribed, you don't need to worry about GAR or anti-avoidance. Now again, talking on substance, one thing which struck me is that in the final IFSC regulations, they have only said that the initiation of the decision making should be done in the IFSC, which gives you a lot of flexibility to offshore some of the, even the management functions or the advisory functions to your entity in Bombay and keep your activity in the IFSC much more restricted. There can be savings in operating cost in IFSC as compared to offshore jurisdictions, especially if it's Ireland or Singapore or Luxembourg. Again, there is no, other than income tax on the manager, there is no STT, there is no commodity transaction tax, there is no stamp duty in the IFSC, and your manager gets full tax exemption. There is a MAT of 9%, but then if the manager is set up as a company which opts for a 22% tax rate, which is the regime in income tax law, then you don't even have to pay MAT. So exemption from that, there is no GST, etc. I'll just spend a minute to say what we can do. So as Deloitte, we provide end-to-end services, both in terms of setup and an ongoing basis. So as you can see here, starting with discussion on the fund structure, what are the key business objectives, key aspects to be kept in mind, and we take this very seriously because a fund structure is like a one-time activity and you have to do it properly rather than making any changes later on and then creating confusion with the regulator and with your investors. So this is a very important step. And then once you have a structure in place, we help in setting up the various entities, trust entity, manager, sponsor, whatever, end-to-end on that. And then we help in the various documentation which I mentioned. So all your documentation can be taken care of. And then finally obtaining approval from SEBI or IFSC authority. And then on an ongoing basis, again, we will do end-to-end, whether it is tax or regulatory. So for example, your advance tax, TDS, income tax return, computation of taxes for NAV. Many times, fund accountants come and seek a help for the tax accrual portion for NAV. So we have a automated system which we use for our FII clients, which we use the same system for computing taxes here. Then computing taxes on redemption, FATCA CRS reporting, SEBI, RBI reporting, and giving statement to investors and on redemption, etc. And then filing the tax return. So all of that is like an end-to-end service.